Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity.
My name is Tom Vassallo with MRW Financial Brokerage, and thank you for participating in this episode of Long-Term Care Seed. In this episode of Long-Term Care Seed, we're going to discuss the evolution of long-term care planning. When I first started in this industry in 1987, the first policy I ever sold was Aetna's original nursing home insurance. And when we talk about nursing home insurance, it's a very limited policy. So this policy was designed by companies that offered Medicare supplement insurance. And this was made to pick up, they identified that Medicare had a shortcoming when it came to nursing homes. They wouldn't pay beyond 100 days. They did have Medicare as some gatekeepers, 3 days prior hospitalization, skilled care only. So this policy was really meant as a standalone nursing home policy to layer on top of your Medicare supplement policy and cover that nursing home risk. With this type of original policy, you would pay annual premiums for life. And those premiums were not guaranteed level. They could increase over time. Now, this original nursing home policy only paid on nursing home confinements and only paid for skilled nursing care. It was really meant to mirror Medicare and pick up where Medicare left off. It was also use it or lose it for nursing home. If you didn't use it for nursing home, you passed away, you didn't get another dollar out of the policy, but you had the peace of mind that you had that coverage should you need it. Now, these nursing home policies had some gatekeepers in them, the same as the Medicare gatekeepers. In order to get a claim paid, you had to have 3 days prior hospitalization. The care must also be skilled in nature. They didn't cover custodial or intermediate care like the long-term care plans today. And of course, it paid in a nursing home only. It did not cover home health care or assisted living facilities. So we were out selling these skilled nursing home policies. They were health insurance policies as a supplement to Medicare. The premiums weren't very expensive because, to be honest, the policies were extremely limited. Skilled care only in a nursing home and only after 3 days prior hospitalization. Then the companies started to realize that there was a gap there. People didn't want to go into a nursing home. They wanted home health care. So we started to offer standalone home health care policies. So now the client could have their Medicare supplement policy. They may have purchased a nursing home policy. And now, because they really don't ever want to use that nursing home policy, they're purchasing a standalone home health care policy. And again, we would pay these premiums. They were annual premiums you paid for life. The premiums were not guaranteed level, and it had benefit triggers, maybe 2 of 6 or 2 of 7 activities of daily living in order to get a claim paid. Maybe if you required supervision due to a cognitive impairment. Maybe your doctor said it was just medically necessary that you received home health care. And it did pay for home care only, and it was use it or lose it for care. If you didn't use it for care, you lost it. There weren't any premiums returned. Now, these policies were really utilized. People wanted to stay in their own home. They'd try and stay out of a nursing home as long as possible. So we really start to see claims escalate with these standalone home health care policies. Then we moved into the traditional long-term care insurance, which are health insurance policies. This goes back, prior to 2000 in the qualified and non-qualified policies. These were all considered non-qualified policies back then, although that term did not exist. You would pay an annual premium for life. The premiums were not guaranteed level. You again had benefit triggers. It could be 2 of 6 or 2 of 7 activities of daily living, and it varied from company to company. Maybe cognitive impairment was a benefit trigger, medical necessity. Some companies even had 2 of 6 instrumental activities of daily living, and it would pay for homemaker companion services. So if you could not prepare food and clean your house, you could get a claim paid. So once again, these traditional long-term care policies were utilized. They paid for any setting of care: home health care, assisted living, adult daycare, respite care, nursing home, and they also paid for all levels of care: custodial, intermediate, or skilled care. But once again, they were use it or lose it for long-term care. Those premiums are not guaranteed. In fact, we have a history of raising rates on in-force policies. And why did we have the rate increases on those in-force policies? Now, you got to go back to prior to 1990 when these were originally all being issued. They were primarily being offered by companies that offered Medicare supplement insurance. And it was there to pick up where Medicare left off or cover more of the gaps in Medicare. And these policies were originally lapse supported. Some of the policies originally thought the persistency in the 13th month would be 70%. In other words, 30% of the policies would fall off the books in the first year. And of course, the insurance company collected the premiums, and now they no longer have that liability. But when persistency ends up being 95% plus, those future liabilities don't fall off the books. So one of the reasons is the persistency was much better than expected. They priced these policies originally with persistency that was similar to a Medicare supplement policy, and the persistency ended up being much more like a whole life insurance policy. We also had a persistently low interest rate environment. And I know many people thought when the single premiums came out, how could companies do that? How could they collect a single premium and provide a guaranteed protection for as long as the person lives? Well, actually, that's much easier for a company to price out, because if they're getting all the premium in a lump sum, they know what the interest rate environment is today and what that money can be invested at and the return that can be generated. When they originally price a policy in a higher interest rate environment and they're collecting just an annual premium, and that premium is going on for life, and all of a sudden they can't invest that premium at the interest rate they expected they could, that's going to create future rate increases. And then, of course, also higher than expected utilization. They didn't realize people would be living longer and at what rate these long-term care benefits would be utilized. Fast forward to today, and now we have asset-based long-term care insurance, and that's where the majority of solutions come into play with us at MRW Financial Brokerage. What does that mean, asset-based long-term care? Well, it really means that they're hybrid long-term care policies. They are considered, it is considered qualified long-term care coverage, but they're built on either a life insurance chassis or an annuity chassis. And I know what you think. My clients don't want annuities. My clients don't want life insurance. Here's the way I like to explain these life insurance or annuity chassis. When I first met my wife, she was driving around in a 1987 BMW M3. Never in my life would I expect she would drive around in a Ford F-150 pickup truck. This is the 1987 Ford F-150 pickup truck. Fast forward to 2023, what she's driving around in? A Lincoln Navigator, which is built on what? A Ford F-150 chassis. But it's built from the ground up to be a luxury automobile, a touring mobile for a family. It's not built to be a pickup truck. It simply happens to be on an F-150 chassis because it fits nicely on there with the platform that they want to offer. Same thing goes with hybrid long-term care policies. By putting them on a life insurance or annuity chassis, we're building on them from the ground up to address long-term care. We're really depressing the life insurance benefits. If you're buying it for a death benefit, virtually any life insurance policy would outperform it for death benefit. I'll give you one example. There's one policy out there. It's built on a joint and last survivor, second to die life insurance policy. So you only get the death benefit after the second death. And $166,000 of death benefit, combined second to die death benefit, could be a $5,000 a month long-term care benefit per person for husband and wife with a lifetime benefit period. In other words, where is all the premium leverage going? It's going to the long-term care. The life insurance, the death benefit, is simply a return of premium, really. I mean, it's nice to know that if you pay these premiums in and you don't use them for long-term care, that tax-free death benefit's going back to your family. By also being on that life insurance chassis, they're able to guarantee the premiums are never going to change. They're able to have cash values in the policy for the clients, and they're able to guarantee the benefits will never decrease. Same is true on the annuity chassis. When it's built from the ground up to cover long-term care, you could put maybe $100,000 in there, cover both husband and wife on a policy, and if either one of them or both of them needs it for long-term care, that $100,000 turns into $300,000 for long-term care. If they don't use it for long-term care, that $100,000 continues to grow and passes on to their beneficiaries. Now, with the traditional long-term care options that we had in the past, clients had to pay premiums for life with non-qualified funds. Couldn't really use qualified funds. So they're paying a lifetime premium with after-tax dollars. We've got a history of rate increases. It's use it or lose it for long-term care. And currently on those traditional policies, we have extremely strict underwriting on those traditional long-term care policies. With the asset-based plans, we have many premium options. We can go single pay, 5 pay, 7 pay, 10, 15, 20, a pay to 65, pay to 95, or pay to 100. Now, why do we have so many premium options? Well, what's nice about these asset-based long-term care plans is depending upon the client's situation, we can really make these different options work for them. In other words, that single pay option is tremendous for individuals that are in retirement and they're retired on assets. They have Social Security, they're on assets, and they're quite frankly worried about possibly running out of money. They don't want to add an annual premium for the rest of their life. But what they may be able to do is move an asset from their left pocket to their right pocket and leverage it for long-term care. And we'll talk about liquidity options and things like that. So that single pay really comes in for individuals or couples that are retired on assets. When we look at the short pay options, the 5 pay all the way out to, say, the pay to 65, that's tremendous for an individual or a couple that is currently working and they want to match the payment period to their working years and their earning years. That way they can pay the policy off, have the coverage for the rest of their life all the way through retirement, but not carry those premiums into retirement. Also, with these qualified long-term care plans, there can be some tax deductions, or they can pay for it pre-tax with HSA funds. There can be some tax efficiencies there that we can create. And then when we look at the pay to 95 or pay to 100 options, those are tremendous for individuals that are retired on pensions. You know, there are some people that have a guaranteed income that's increasing for the rest of their lives. They still have a mortgage. They still lease cars. They aren't worried about adding an expense in retirement because they have that guaranteed increasing pension. And that pay to 95 or pay to 100 option can really make sense. So we can really design how we're going to fund a long-term care planning solution based on their scenarios. What else do we have as far as premium options? We can fund it with non-qualified premiums. Maybe we have a retired school teacher with drop funds that came in and they're qualified heavy. We can fund a plan with qualified premiums. We can even 1035 exchange from an existing life insurance policy or annuity into a long-term care solution that still passes the value on to their beneficiaries, but if they need it for long-term care, it all comes out income tax free thanks to the Pension Protection Act. So, you know, again, depending upon what the client's situation is, we can take a look at the funds that they have available and determine the most efficient way to plan for long-term care. We also have tremendous cash value options. We have options that a client can move their money from the left pocket to the right pocket, and it stays completely liquid at all times. If they want all of their money back, they can get all of their money back at any time. We can get more leverage if we move the money from the left pocket to the right pocket and it becomes fully liquid after 5 years or 7 years or 10 years. Or maybe some clients aren't worried about the full liquidity. They're okay if 70% of the funds that they put over or 75% of the premiums they pay stays liquid. Maybe there's other individuals that say, you know what, I'm not going to need this money in retirement. I want the maximum leverage for long-term care, so the cash value is really going to be depressed, but there's going to be a death benefit there for my beneficiaries if we don't use it for long-term care. So again, we have the ability to design these plans around these clients' planning goals. What about benefit options? We have options with or without inflation riders. We can go as short as a 2-year benefit period and as long as a lifetime benefit period. We have policies that pay reimbursement benefits and policies that pay cash indemnity benefits. So once again, depending upon what the client's situation is, depending upon what's important to them, maybe they have a family history of cognitive impairments and a lifetime benefit is really important to them. Or maybe they have someone that they would want to provide care for them, so they don't want to go to a licensed home health care agency, so a cash indemnity benefit is important to them. We can design the plan around the client's needs. What do all of these options mean? I mean, we didn't get into the particular products, we just went through the options. It means that's where I can really provide a value add. I think the most productive conversations I have is when someone calls and says, hey, I've got a guy, or I've got a case, or I've got a hot prospect. Here's their situation. Here, and we have a conversation. And then we can put together a planning solution that makes the most sense for that particular client. Once again, my name is Tom Vassallo with MRW Financial Brokerage. Thank you for participating in this episode of Long-Term Care Seed. And if you do have any plans you want to discuss and how we can really use these new asset-based long-term care solutions to provide your clients a tremendous amount of value without having to pay for care, please feel free to give me a call at 813-875-6331. Thank you and have a great day.
Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity. Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity.